by diversifying your strategies. It's the same concept as an index, which diversifies across different names, right? Like SPY has energy names and financials and technology and communication. Like you can do the same thing with strategies and get a much smoother equity curve with a much stronger positive bias.
Disclaimer time. This is where I tell everyone to lighten up. It's just a podcast. Trading is like that roller coaster at the amusement park. Thrilling, unpredictable, and potentially stomach churning. What works for one person might leave another clutching their hat in the wind. Our hosts and guests, they're awesome, knowledgeable, full of insights, but we're not financial advisors. So don't rush to make any investment decisions based solely on our banter. Always consult with a professional or do your own research. Plus, let's face it, we like to have fun, laugh, enjoy the trading ride together. It's all in the name of good podcasting fun. So remember, take it easy, don't bet the farm, and keep your seatbelts on at all times. Thank you for listening.
Why don't we start with just kind of an overview of like the conditions, how the setup works, like what the entry conditions are, and like, I guess just how you manage the position. We can kind of work through like start to finish that way.
Yeah, we can do that. Let me find a recent example. Apple was not great, but
HPE was one that we just, I just took that trade. We can look at that one.
Ooh, yeah. Yeah, this is a good one.
Yeah, it's got some good past examples there too.
Yeah, that's a good one. Okay, so yeah, the RSI strategy, I'll come back to HPE. It comes from the indexes. This is where the idea comes from.
This is the close open one that I don't know if we've talked about close open yet at this point either.
Yeah, so it's a component of close open. So it's RSI, so relative strength index. That's the oscillator down here on the bottom.
Mm-hmm.
Just standard, just standard RSI, but it's a 2-period model. So I'll open settings here. So it's the 2-period. That's the length.
Mm-hmm.
Instead of like the standard Wilder RSI, I think is 14 days.
Okay.
This uses 2. The idea comes from, I think it's Larry O'Connor. He's the one that really did the original research on this. You can look it up. I think it's just O'Connor's RSI 2. His research was on SPY or on S&P 500. And essentially it's just when RSI is, I think his model, it's when it's below 20, you enter and then you exit when it's over. Okay. I think he uses 80. I think he uses 20 and 80. So I started researching it on the Qs. If it works on SPY, it'll work on the Qs. And I adjusted the criteria to entries when it's below 10. So when the oscillator is below 10, and exit when it's above 70. So entering a little later, you really want a strong signal. And exiting a little sooner. And so if you do that and just look at QQQ, it has I've got the numbers here. I mean, it's about a 74% win rate. Expectancy per trade of about 3.5%. And there are some other tweaks you can do to it. But my thought was, okay, so this can work for QQQ. And I did fold it into the close open strategy I run.
Mm-hmm.
The idea with close open, just real quick, if you go back basically 50 years, however long you want, and you look at the average returns, if you just held from the close of the market session to the open versus holding from open to close is flat. It actually, or actually down over a long period of time, like over a week or a month or a year, it can be different. But over an extended period of time, there are no gains holding the U.S. market during the open.
And that makes sense too, because I think like the majority of all the catalysts all happen after market hours are closed. So like all your earnings reports, all your CPI, your jobs reports, all those things all happen. Yeah.
And if you just hold from close to open, you can actually outperform the index and technically only be exposed 50% of the time.
Yeah. The reason why we love this is it was a good way to deploy some extra capital when it's not being used in the gap and go, because you finish the day and you got half your account sitting there. What are you going to do with it?
Yeah, exactly. And that's how and that's where this comes from. Like with gap and go, I mean, like, right now as we're recording this, middle of August, I mean, it's been active lately.
Mm-hmm.
My gap and go account is full.
Yep, mine too.
Yeah, like it's completely full and everything is running.
This is my favorite part when the gap and go is full like that. This is the best time.
Yeah, it's hitting and like everything, everything is ripping. But most of the time it's not. Most of the time you're only holding 1 or 2 or 3 positions, and so you have a majority of your money not working. So with close open, literally overnight, you can be getting some return. And so what I did with, essentially starting with close open, layering in RSI, and then just looking in times when the probabilities are in your favor to take a trade, I've got the close open, median return sitting at around 37%, 35%, average return about 40. But I took the RSI here, and here are two where it's been two recent examples on the Qs. One end of July. Then there was one down day after that, and then the market just ripped. And then actually just yesterday, there was another signal that we just took. But I took this idea, and if it works on an index, it should also work on individual names because indexes are made of individual names.
Right.
So it's just an aggregate of the component behavior. And it does. You can apply the same idea to individual stocks. So it's the same concept. It's 2-period RSI. You're going to enter below 10.
Are we using 10 or are we using 5 on
7.
this one? I think
on individual names, I use 10.
Okay.
5, you don't get enough. You don't get enough sales. And what I've found looking at it is frequently stuff will show you a signal of 5 like during the day, like here on HPE, but then it'll close a little higher. They tend to get balled up towards the end of the day. So 10 works real well. In practice, the way I execute this and the way the strategy works is I sell half when it gets to 70, when you get the 70 signal, and then I sell half the next day. So Apple here is a good example. We've sold half on this day here. We got the signal and then sold half the next day. And then you got another one. You sell half one day and sell half the next. And that takes your win rate. It gets your win rate up to about 73, 74%. Expectancy per trade is about 3.5%. So it's not great, but the average hold time is only a few days. I think average hold time is about 5 days. So Hewlett Packard here is a good example. So when was the actual signal here? So either one. So Wednesday or Thursday, and then today it's starting to turn around and it's moving up. Now, those are the numbers just like raw, unfiltered. If you just look at everything in QQQ and you apply this, and that's something else worth mentioning. With RSI, it works best with bigger stocks, with bigger companies. And that makes sense because they have more institutional backing. Institutional names are going to be the ones that keep the price floor up. If you just look at like small cap, so if you filter this down to $2 billion and less, so essentially the gap and go market, it doesn't work. The strategy is not profitable. It actually you're probably going to lose money. But if you filter it to 100 billion or higher, the compound growth rate is, it's about 22% or so using shares. So it's a decent strategy. Again, it's essentially taking advantage of mean reversion, right? Like the trend is up, there's a pullback, you ride the bounce back up.
And that's the key you just said right there, the mean reversion part of it, because gap and go's momentum strategy. What do you consider close open?
I'd say that's trend following, more momentum. Yeah, trend following. Like that's essentially what you're doing. The market has an upward bias. By participating, you're taking advantage of it. But with RSI, one of the things that I really like about it, so here is CrowdStrike. This was a good example. I took the entry on 21 July, and look, it had like 5 bad days, and it was hurting. And I exited this trade here, testing a stop loss rule. But if I would have held and followed it until the exit signal, I would have exited here 30 July for a small loss, and then here 31 July break even. But more importantly, once these signals fired, look what happened. It had recovered, and if you had chased your stop, so just use the day's low as your stop, it would have been a highly profitable trade. That's the thing. And then recently, look, there's another pullback.
So do you wait for any sort of confirmation then, or is it just as soon as you see below 10?
So that comes in, and that's where I was going to go next, is that the best way to use this is with your selection. So you want to look at names that are $100 billion or higher, or honestly just filter to the Qs. That's what I do. I just filter down to the Nasdaq 100.
Okay, so just anything in the Nasdaq?
Yeah, just anything in the Nasdaq. Because, if there's something small there, it's still got institutional support. This will work in SPY as well, but it works better with the Nasdaq. And you want to look at things that are ideally, the filter I use is you want to see names that are at least 30% above the 200-day moving average. So what that does is it gives you names that are in a strong trend and are reverting, right? Like they've had a big move up, maybe they're cooling off, and you're just taking advantage of that bounce.
Yeah.
Ideally, we had names like Hewlett Packard here. When you get that signal, it's right around a major moving average. Ideally, the 20-day, but as long as it's above the 50-day, you're probably okay. And then look here was one on Hewlett Packard. Look, it pulled back to the 50 and then it ran. There was another one back here. It pulled back right there to the 50 and then it ran. So again, this is a mean reversion strategy, and that's what I was looking for, right? Like gap and go is a breakout strategy. Close open is more trend following or momentum. This is mean reversion. And that's important because each of those has a different edge and they perform well at different times in the market.
Right.
And by doing that, by diversifying your strategies, it's the same concept as an index, which diversifies across different names, right? Like SPY has energy names and financials and technology and communication. Like you can do the same thing with strategies and get a much smoother equity curve with a much stronger positive bias. But I think strategies work even better because strategies, you can have strategies that are mean reversion. So you take advantage of, weakness or temporary pullbacks in the market, but you can also do ones that look for short opportunities in the market, look for rotation from strength from one sector to another. So, and then the other thing with having multiple strategies, they compound with each other. So a good example here, I have the data over here, a little bit fuzzy here. It's zooming in on a screenshot, but it gives the idea. So the blue line and green, the blue line is close open version 4. The green line is RSI. So those are the two strategies. That's the performance of those strategies over the last 5 years. It's just 5 years. So I know it's only 5 years, but this is to illustrate a point. The growth of one is, about 40% a year. The other one is about 25%. Well, you would think if you add, let's say 40 and 25 together, well, what's your returns? 65%?
Right. Exactly. Looks like it's a multiple of that.
It's a multiple because they compound much more quickly. There are times when one is moving down and the other one's moving up, or vice versa. And if you think about it with close open every day, not every day, but there's, a 58% chance that every day you start the day, you have more money. You have more money for your RSI strategies. And with the RSI, there's, a 75% chance that when a trade closes, now you have more money to put into close open. So the sum of them is greater than the total of their parts. That's the point here, right? Like if you just add up the total performance, 275 and, 350, whatever, it does not gets to be more. And that's the point of having multiple strategies. I also have one with gap and go.
That's what I was going to ask.
Yeah. So to be honest, like having some issues building a portfolio simulator, it gets very tricky.
Well, with RSI and close open or RSI or close open and gap and go, like the two are operating at different times in the market, so they're not really overlapping. But if you have to choose between RSI and gap and go, then what's how are you making that distinction?
Yeah, you go with the gap and go because it
has the higher return.
The upside there is much higher. Yeah, I mean, the upside for a gap and go strategy is a name runs 400%. Right. Like with RSI, I mean, you're getting, it's just a bunch of base hits. Like you're just getting a bunch of, 3, 4, 5%ers, unless you use options.
So one thing that I have noticed then with the gap and go is, I think you mentioned it a little bit earlier, but it tends to, you go in batches, right? When earnings seasons happens, you're getting a lot more of them, and that you're a lot busier. More of your capital is deployed at that point. But then when you're between earnings seasons, then you're just sitting around. You get 1 or 2 here and there. So it sounds like that's the point when you're trying to deploy that.
Yeah. That's essentially the thing. But yeah, when you have to have a hierarchy here. I mean, you want to go with maybe your best performing strategy as your default. But yeah, there are times where, another strategy works better. In reality, one I also run with this is I run an orb, so an opening range break. So there's nothing going on. There's no, so like for the last 2 weeks, there haven't really been that many RSI names. There haven't been very many, gap and goes. So during the day, I just, I run, the opening range break, just a standard 30-minute opening range. I do have some nuances to it. You know, I run it on futures, you know, and it's, you know, about a 21% return on risk. So again, it's a good way while your money is just sitting there, go ahead and run the strategy, and then it's free by the end of the day. And what do you do at the end of the day? Close open.
Right. And
So,
hopefully you got more money to do that with.
yeah, so your money's essentially always working. Yeah, and those two work really well together. Close open and opening range break, because they literally working at opposite times of the market. So,
Okay, let's talk then, going back to RSI then, let's talk about how you're managing risk then. You pointed out one example there where like you took an entry and then I don't think it was this stock, it was a different one, but like you had a couple days where it just kept selling off on you, and then like how are you managing that? Yeah, there's a good example.
Yeah, this is a better one. So this is one recent. I am holding this. I am in Nucor Energy. There was a signal here last Friday. I am still in the trade. I was in, so I'll go ahead and measure. Here was my entry, and it's currently down. The trade on shares is down 10%. I'm in options, so it's down more.
Did you size that as a all or nothing though?
Sized appropriately though. Yeah.
Okay.
And that gets into risk. So yeah, with this strategy, there are no stop losses. Your stop loss is the exit when the RSI hits 70. If you run the back test and look at it, most of your losses are around 5 or 6%. They're manageable size losses. They're really not that big. And again, you win 3 out of 4 trades. However, the tail risk is huge.
Yeah.
Out of 500 trades, you'll have like 3 or 4 that are 30% losses.
How many of those have an actual catalyst that you can predict?
Predict, I don't know, but earnings.
As in like earnings. Yeah.
Earnings, yeah, it's most of them. When I looked at it, it was like 9 out of 10 of them, it's earnings.
Yeah. Yep.
You're taking a trade right in front of earnings. And, so that's the thing. So I tried testing a lot of things. 2 potential options came up for stop losses. So one, and this was the one I tried for CrowdStrike, is after 3 days, if it's down 7% or more, you kill the trade. And so that was this. So here it is. Enter 1, 2, 3 days. It closes down more than 7%, so I killed it. The other one is just a hard 10% stop loss, because that's the line in the sand.
Yeah.
Trades are either about a 6%
less
loss
than 10 or more than 30
or more than 10. And if they're more than 10, they're a lot more than 10.
Yeah. So,
but when you do that, you do end up missing some that recover. And here's CrowdStrike. That's why I mentioned it. It at one point it was down 10%, but then it recovered. And if you held it, it actually ended up being a pretty great trade. Like you potentially missed something here.
When I look at this chart right here, well, the thing that stands out is that trend line break right there. If you just waited for that trend line break,
then
maybe you would have had better, like just another form of confirmation, really.
Yeah. And that's kind of where I am now.
Like I like your first entry because you had an actual moving average there or something to base it off of.
Yeah.
Like you almost wanted to put another one on that big doji when it hits the 50 moving average a couple days later.
So one that worked out real well.
Ooh, I'm in this one too.
Still in.
Thank you for the heads up on that one.
Is Coca-Cola. And so this gets in kind of to the point you were talking about. So we kind of go back in time here, right? So at the time, here was the signal. It was right here, 11 August. That was the signal. I actually missed it at the close. I couldn't get a fill because I was trying to do options and couldn't get filled. But luckily,
like it worked out for you,
luckily the next day it gapped down,
right?
And I bought it because it was like, okay, because the RSI at that point was like a 1. So I bought it, and I was also looking at the chart here. Looking at the chart on this day, this was the information I had. Decent sized wedge here, a clear area, previous all-time highs, had bounced on it, gave me some support. So I was like, okay, this is Coca-Cola. I'm fine taking a risk here. Got an RSI signal. It fits my 5 rules. And then Coke is at all-time highs. I exited here on the first signal. I closed my first batch of options. They went like 100%. I rolled them into a new batch and just decided I was going to hold them and let it run like I would normally do runners. They went 125% here. I still had some Wednesday, closed a little bit and rolled into them, and now I'm in my third roll with Coca-Cola. It was total. The position went, like 500%. But that gets me to my point here. I think options are the best way to manage risk with RSI. So essentially, what I do is, if I know 10% is kind of the line in the sand, and the position size is about 10% as well. So if you have a $10,000 account, you should be looking to put $1,000 worth of your capital for each trade. So then I go from that and say, okay, if a 10% loss is the largest loss that I should be willing to withstand, like that's essentially what I'm trying to avoid. Anything less than a 10% loss, I'll take it. Anything more than 10%, we want to avoid. Well, if you have a $10,000 account and you're taking a 10% position, okay, that's $1,000. A 10% loss is $100. You just take $100 worth of call options and run the strategy. There's no way you lose more than that 10% loss. Now, on average, that means your average loss, in total notional risk for your account will be larger. But in a case here like Coca-Cola or CrowdStrike, where you catch one that rips, you're going to win significantly more because you get that delta expansion on the way up.
I think this is going to limit your account sizes then, or the size stocks that you can trade.
It does.
So for that size, you probably don't want anything more than like a $50 stock, I'm guessing.
Well, so that gets into, strike and expiration.
Yeah. I don't like going too far out of the money because then you're just buying all premium. I like to have at least something that I can salvage.
Yeah, you're buying volatility. And this is one where that your average move on the underlying is like 3% or 4%. So you need to be pretty close to at the money. Like you need to be really close. And for me, I've been buying like 1 or 2 strikes out of the money, like pretty close. Like, you don't want a delta value of less than probably 45. Cause then, essentially once it goes in the money, you're getting you're getting all of the move.
Right.
But the other thing is expiration. Yes, the average hold time is 5 days, but you don't want to have to fight theta.
Yep.
So you need to stay, at least 2 weeks out of them, at least 2 weeks out. But the theta decay is super aggressive at 2 weeks.
Yeah. You almost want to go at least 2 months.
I was going to say between like 50 and 60 days. 45 days, you're usually fine, but you got to figure like, what if the trade takes 2 weeks? Okay. So you tack 2 weeks on the 45 days. There you are. You're sitting right at about 60 days. Yeah. So 60 days, maybe 40 delta. For most things, I think it's a reasonable price. But yeah, something like CrowdStrike, a small account, you're not going to be able to take this. Or
HPE was something that was right in my wheelhouse.
Yeah, WDC. This one was a great trade. Like I caught it here, and it was also an inside day. Those are other little things I look for. So I got an RSI signal on an inside day, and I had a trend line. So I got real excited about that one. Options went like 80%, but because it's a $400 stock, it paid really well.
Yeah.
But yeah, small account, like you couldn't do this. So you could do it with shares, and just buy 2 shares or 3 shares, whatever you can afford, and just play that way. And look, you'll still make money, right? Like, and if you run shares, you can still get about a 20-25% return. That's nothing to sneeze at, considering you're only in the market for like 5 days. Yeah, that's the thing. Like, yes, it's only a 20% return, but if you look at your return divided by the amount of time you're in the market, the amount of time you're exposed to the market, so your risk adjusted return, it actually is a lot higher. Mm-hmm. The average exposure to the market with RSI it's still only like 35 to 37%.
And one last question then, as far as just on the argument of options versus shares. So volatility should be increasing if things are going down, right? So are you basically, if you're buying call options when RSI is like at the low there, are you buying it at like peak volatility as well? Do you have to be careful of that?
That is something to be aware of. I've tested it. It hasn't shown to be statistically significant in testing. So I've looked at the volatility on the options contracts themselves. I've looked at VIX, so general market volatility.
Yeah.
Yeah, like it's not showing that it really matters that much.
Okay.
And I looked at it, in high volatility environment. So I looked at times when VIX was like over 40. The thing is, when IV is high, like yes, you're fighting that move, but when IV is high, that means the implied move is also high.
Right.
So it kind of works out. Like yeah, volatility is high, and you that volatility crush, that Vega crush is going to get you, but the expectancy is actually higher. Like the average expectancy for a trade, again, it's low 3%, but when IV either on the name or on the market is high, well, your expectancy goes up. So I mean that's what honestly that's what options pricing is supposed to do, right? Like you're getting compensated for that. So
Makes me wonder there's something around maybe selling puts down there too, if you don't want
yes,
to go long options. General Mills,
yeah,
huh?
I think that would be a very good possibility as well. I haven't completely tested that, but with selling puts, the issue there is you're going to tie up a lot of your account.
Yep.
But yeah, I mean, with something like HPE here, yeah, I think this would be a great opportunity if you think that this is a long-term hold, something you'd be willing to hold shares in. Sell puts, yeah, you're selling a put when IV is high, so you have about a 75% win rate right here. That means 75% of the time it's at least higher than that. So you could be fairly aggressive with your put selling. I mean, where is that for HPE? Like 53. So yeah, you could probably sell like the 53s or 52.5s, like something really aggressive here. And then if it just goes sideways,
yeah, then you're happy.
You're fine. Like who cares, right? Like, and you could sell something really short term because the win time, the hold period is about 7 days. You just sell like a 2-week put, or a put spread may work even if you have a smaller account size. Right? Like,
cap the loss.
Yeah, cap the loss there. So yeah, selling puts is definitely a good option. And again, especially if you're limiting this to Nasdaq 100 names, theoretically, those are all high quality names anyway, right? So like in theory, you should be okay with holding any name in the Nasdaq. Now there is some survivorship bias there, right? Like people do.
Yeah, you got to remember those indexes change.
Yeah, they do change from year to year, and that's important for people. Like if you're doing your own back testing, make sure you get point in time membership data because, a stock that might be included in it this year or next year coming up, like, SNDK or something. Well, 5 years ago, it wasn't in there.
Yeah.
So you can't include SNDK from 5 years ago if you're testing QQQ performance. Like you got to get point in time membership data because there is, people are coming and going from the indexes.
Wasn't Blockbuster part of one of those at one point?
Yeah. Yeah. I think that the stats are 25 years ago, it's less than 180 names in SPY are still there.
Oh, wow. That many.
Yeah, I could be wrong there, but it's a significant amount. It's a significant amount of turnover. Yeah, you got to have the correct membership data if people are doing back tests and stuff using AI. And that's important. I think that's probably the best use of AI for most retail traders is in back testing. Come up with a strategy, put some constraints around it, put some rules around it, and get it to run a back test. For years, I mean, it was limited to people who had the knowledge to do coding in Python or R or something, and that's what I did. But yeah, now with AI, you can, especially Codex. Codex is fantastic at back testing. So much better than Claude, and I don't want to hear it. Codex is better, and I don't want to hear it. Claude code is like, okay, you just graduated from an MBA and you know some shit. Codex is that like old Danish guy that barely speaks English that works on your team. And like when you need some shit to work the first time, you send it to him and he comes back with this like super gnarly code, but like it works.
He's saying he's the guy you call when you need to crash the dinosaur park and steal the DNA?
Yeah. That's code. Codex just gets done. But yeah, RSI, again, it's a really good strategy. It's not a world beater. Again, like, it's not going to get you 100% compound growth.
Until you pair it with something else.
Options. Using options, I'm still working on the testing. I mean, with options, like the number can get a lot higher. It can get a lot higher if you can tolerate the risk. You just have to size correctly. And that's the key with using options is to control your risk. You can't put, 10% of your damn account into call options on RSI, because if it loses, there is a probability that like a non-zero probability, and like, I mean, it's like 2 or 3% that like you could have a 30% loss. But yeah, that's, so we kind of skimmed over that. The worst
Right.
losses occur around earnings. They always occur when you enter something like 2 to 3 days before earnings. And yes, on earnings, I know, like, well, what if it has a big up day? Okay, that's cool. But like as a trader and as a new trader, you need to be concerned with risk, right? Like you need to make sure you can stay in the game as long as possible. Okay. So Moderna is a name, right? Like we hit this week and like, yeah, it's great. Look, maybe it could do what Moderna did. But, my entries on Moderna were, over a year ago and they were down here and I was obsessed with risk. And you look at, I didn't start buying until I had a clear defined risk level.
Yep.
If you just control your risk and then be patient, maybe this could happen. And I also want, I specifically remember, and I think you do too, people asking why was I taking a shot with Moderna? And I said, because this company could
Because they're going to cure cancer.
it could literally cure cancer.
Yeah.
And this thing is down at $24 and it's showing resistance. And then it got over the 200 day at like $28. So, so the worst losses for RSI all occur around earnings. If you just avoid taking positions right in front of them, that helps. Apple's a good example here. If you look, Apple had a RSI relatively close to earnings. In this case, it worked out because you could have got out of the trade. But yeah, just wait until earnings. And look, if it does gap down and it had a signal, well, you're going to have another one on earnings.
Yeah,
If
exactly.
it runs, well, just wait. Be patient. Let it come back to you. And what was it, Google? And you'll get another entry, right? Like here, Google's a good example. This was one, right? Like, because those are the best trades anyway. The ones that rip and then pull back. Like in all honesty, that's what you're looking for. You're not trying to front run the move. You're waiting for it to show you a move, and then you're taking advantage of the mean reversion. But yeah, that's it in a nutshell. I can send you the research on it. So I have a full summary report, and then like an implementation guide. So, but yeah, it's one of the essentially 5 that I'm running, and I'm pretty happy with where I am. There's one more I want to get, but it's gap and go, my 5 rules, close open, RSI, and then an opening range break. And between those, my account's moving pretty consistently. They dovetail together really easily. Other than the 5 rules, they can pretty much be fully automated, and that's what I like about it.
Yeah.
I don't have to
I
sit
agree.
here and make a lot of decisions and try and interpret charts. The rules are very clear. They're very tangible. It's something that can be automated. And I'm working on that. I'm working on building the algos to get them automated.
I think you answered all my questions in too. So yeah, if you just, I think that document, send me that. That way I can post it in the show notes. So if anybody wants like the screener information or like how to set up, like the different criterias, you'd have that for people to grab. Is there anything else with this, that any other notes or any other like ideas or things that need to be aware of with any of these?
No, I think that's it. It's pretty straightforward.
Yeah.
I encourage people to, test it out, entering at a signal of 10 or a signal of 15. I did a full matrix entering literally every 5. So entering at 5, 10, 15, 20, 25, 30, exiting at 60, 65, 70, 75, 80, like all the way up. 10 and 75 is about perfect. You start going lower, you don't get as many trades. If you start exiting higher, you get higher drawdowns.
Mm-hmm.
Max drawdown for the strategy, didn't mention that. It's about, I want to say it's about 27%, unless you avoid the big losers. If you avoid those big losers, those really big ones, it drops to about 15, 16%. Your max.
So I thought you had it like half of that.
Yeah, about 15, 16% for max drawdown, which I'm comfortable with. Like that's, it still means you could have some losers, right? Like because these they tend to run in clusters. That's the other thing. Like you just tend to get like 5 or 6 or 7 all in a couple of days. And so, the market tanks. Well, you'll have 5 or 6 or 7 losers all at once. So, I think it would help if you have a list of names. Maybe don't take all memory stocks, right? Like there was a time a couple of weeks ago where like MU, SNDK, WDC, Intel, like all of the memory names, like they were all pulling back. Well, you could hit all of them, but what if it's the sector that's tanking?
Yeah.
Right? Like, so maybe take 1 or 2 there. And then like, if you get like a Coca-Cola, okay, well, that's cool. And then like, can you get something else, right? Like, Macy's, take Macy's. So it can be helpful to make sure you're not over concentrated into a particular sector. But yeah, that's kind of the other thing.
Last thing then before we close up here is just that you have all these research papers and other things. If people want to learn more about all these different strategies, where can they go to find all that stuff?
Oh yeah. So yeah, I still have my trading room. It's the Construct. I haven't been active on social media since we got to Italy, but you can look it up there. I do still have a YouTube channel. Again, I haven't been active since we've moved, but yeah, the Construct. And then I'm in your room sometimes posting if people want to find stuff there. I don't know if I'm going to get active on social media again between being in Italy and the SpaceX IPO.
Yeah. Lucky.
Yeah, because I had private equity in SpaceX
Yeah.
from 2021 and 2022. Not as much as I wanted, but I mean, honestly, it changes things. Like
I imagine.
it changes things, and so I'm just kind of taking a break from it. I just in general don't like social media.
I understand that.
You know,
Yeah, social media is not my favorite thing either, but yeah, definitely jump in. You find us on our Discord. Cam likes to come stream the close with us on Fridays, so you always can pick his brain then. And then he's every day in his room. The Construct, I'll have links for that in the show notes. People can jump in. Otherwise, Cam, thank you very much for taking the time to explain this one. And sorry that Joel couldn't make it, but I think he's actually careening around Italy as well right now. I think he's in the northern part though.
Yeah, I think he's in Greece. Yeah, he was in Rome, I think maybe earlier this week or last week. If he was going to be there for a couple of days, I was going to try and get down there and meet up with him. But yeah, he was, it's a cruise. So I don't want to get into his information. He's only in town for a couple of days, and I'm sure he's really busy. So
yeah.
But yeah, then he said he's going to the other parts of the Med. So
when we get him back, then we'll have you guys compare notes.
Yeah, and definitely, we can walk through this more again. You go through the close open. If you want to.
It sounds like I thought we had done close open, but I guess we hadn't. So maybe that'll be the next one that we do.
Yeah, I really like it. I really like it. Very straightforward, just cut and dry. You're buying the close, selling the open. There are a couple of times where maybe you add a little leverage, or maybe you skip a day based on just like probabilities for the market. But it's about a 58% win rate. You don't always win. Sometimes there are losses, but over the course of a long period of time, I mean, the return is, mid 30%, and it beats buy and hold almost every year. Not every year. It doesn't win every year, but about 85 to 88% of the time on a yearly basis.
And
close open is better.
And it doesn't interfere with your day trading, which is the best part of it.
Exactly. If you're going to day trade, I mean, it's free money, right?
Yeah.
It's as close to free money as you're going to get, right? Yeah, you got to still take some overnight risk, but just size appropriately and you'll be okay.
This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.